Well, let's welcome Jigar Mistry, co-founder Buoyant Capital, who joins us on the show. Hi, Jigar. Good afternoon. Good to see you in. What are you all doing right now? Allocating money, or are you all a little bit nervous and waiting by for a better opportunity to get in? What's the current cash holding you're sitting on?
Good afternoon, Nigel. Thank you as always for inviting me to your show. See, cash, frankly, doesn't really, as an asset class and as an active manager, it doesn't really feature at the top for us. I'll give you a very interesting statistic. If you were an investor in the past 25 years, you would have seen close to 6,500 odd days. Of those, the best 10 days have been responsible for 53% of market returns. If you magically happen to miss all of those 10 days, your returns would be essentially half for a 25-year period. So at least as an active asset manager, we think that, a huge allocation to cash, sometimes at the family office level, who are our clients, and then within us, leads to double entry and is not really productive. To the first part of your question on, where we are allocating, frankly, I think, two themes stand out to us. The first is, and it might be surprising that consumption looks like a very decent space, right? It hasn't done a lot over the past 4 or 5 years, coming from a very high sort of a PE multiple. In the intervening period after COVID, a large part of the government focus was on CAPEX, state, center, and PSU. And over the past 2 years, starting from states and even to the center, a large amount of money, by our count, some 6 or 6.5 lakh crore, which is 1.7% of GDP, has been transferred in the hands of people. Right now, if sort of the concern around IT is getting elevated as well, consumption will not be a bad thing to play over the next year, 2 years or so.
So you said the amount that's been transferred has been 1.3% of the GDP. Is that the amount we've seen with various, say, election-related SOPs, etc.?
Right, Rima. So we total 3 parts. One is what the states have been transferring as part of social spendings. The central government giving up almost 1 lakh crore of direct income taxes and part of the GST foregone. So we've analyzed the budgets of the past 16 states that went into elections and found that for many of them, the social spending bill is higher than the CAPEX bill. And what has driven the Indian markets in the run-up post-COVID until September 24 may not be the same sectors driving it over the next 2 years or so.
So you would bet on the consumer staple companies? Because up until now, the narrative was that in India, the K-shaped recovery is there and it's getting more pronounced. So even when we spoke to Bajaj Auto earlier, he said the top 25% in terms of the top models, price-wise, they continue to sell. It's selling like, I'm paraphrasing here, but it's selling aggressively. So you just get the sense that the K-shaped recovery is getting more pronounced in India. But you think that thesis might get challenged and it's time now to bet at the lower end of consumption?
Precisely. Just a small clarification, Rima. The number that we calculate is closer to 1.7% of GDP. Okay. But yes, to the second part of your point, absolutely the lower end of the consumption, which has essentially been forgotten for the past 5 or 6 years, is something that can be a theme. See, you look at the total private final consumption expenditure, it's about 204 lakh crores. The total sort of salaries related to IT will impact premium consumption disproportionately, even if there were a slowdown. With 1.7% of GDP getting transferred, the only piece of the puzzle that is missing is how the monsoons play out. If they are broadly okay, and it remains to be seen, El Nino and the IOD is essentially what we are tracking. Reservoir levels are just about okay. So if all of that plays out, then I think consumption can emerge as a very strong theme.
And these would, sorry, yeah, go ahead.
Yeah, give us some more clarity. What kind of consumption are you talking about? If you would be very gracious if you could go ahead and name stocks, but if you could at least drill it down a little bit with regard to themes that you like within consumption.
So Nigel, stocks are a little difficult, as you know, but see, in terms of granularity in consumption, it initially started with a large part in the discretionary space, right? So you saw auto do well, travel, leisure, that part of the discretionary premiumized consumption. The next round of growth will, in our opinion, be staples. Again, those boring businesses, but, with some amount of volume growth coming in, valuations not cheap, but not as expensive as they were 5 years ago. That is the incremental part which could do much better as well.
What about entry-level cars, two-wheelers, other than consumer staples? Is there any other pocket that you would bet on at this low-end consumption?
Not really, Rima. So, see, what we're getting from the ground is also that part of CV business is under stress. But other than that, I think the personal vehicle segment and the consumption at the staples level look reasonably okay.
For these consumer staples, in the past, when they were in their bull run, what drove the upside, other than the value growth, was also PE re-rating. So from here on, do you expect the upside that comes in from consumer staples only to be indexed to the earnings growth? Or because valuation still, according to many people in the market, is expensive for consumption names, these FMCG staples. So do you see a PE re-rating also?
Right, Rima, because see, one part is that relative to whatever parameter you can call for, and we have run this regression across everything, the SIP inflow is not really reflecting either to 1 year, change in markets, 3 year, 2 year SIP, the change in sort of growth rates, etc. So it looks like that we have arrived at a phenomenon where the percentage of household savings will move to a certain number before it correlates to any other variable that we can think of. Now, obviously, there could be variables we are not thinking of at the moment. But if that were to be the case, then the local money doesn't really have a very large escape, right? If you are an NRI, you can take out like $1 million. If you're not an NRI, then a quarter of that. And everything else must be invested in India. Now, that would, immensely mean that the table waters of valuation across the board will stay elevated, and wherever earnings growth emerges, the market comes back at them with some level of ferocity. So when you're doing those discounting, reverse discounting cash flows, you have to account for a fact that some part of it will always be unexplained for.
Got it, Jigar. Thanks a lot. Short but effective chat. Appreciate you joining in and giving us those themes that you like and how you're looking at markets. Look forward to chatting up with you soon. Well, time to slip. No, let's not slip into a break. Actually, Nimish is waiting.